Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. And I'm Ed Cox from Magnolia Wealth. And today we are going to continue discussing the 5 pillars of financial planning. We are on taxation. Last week we discussed the history of taxation and maybe how that's going to affect us moving forward. Today I wanted to dig into some of the tools we use when we're doing tax planning. Our first tool that we'll talk about is a Roth conversion. Most people have probably heard of a Roth conversion, maybe know some generic rules about how Roth conversions work. But I wanted to get into some of the rules as to how they work, and also maybe some of the things you haven't thought about or were unaware of when you're doing a Roth conversion. So let's dig into that, and I hope that this will kind of help you understand more about the Roths. So once again, here's our 5 pillars of financial planning, and then we are on tax planning. History we talked about last week. Today will be Roth conversions, and then QCDs and tax loss harvesting we will discuss in future episodes. I will say I'm putting this video out. Hopefully it'll go out Monday. I'm doing this Monday morning, and I'm doing that so that I think I'm going to slip in maybe the end of the week a discussion about the Fed and what they're doing. They've got a meeting this week that should give us an indication by Thursday as to what they're going to do with interest rates. And so I'd like to have a little quick video that I can put out later in the week about that. So this should hopefully go out Monday, but be looking for one to come out maybe the end of the week. Okay. So Roth conversions. What is a Roth? Contribution versus conversions, and the 5-year rule. So we want to go over those 3 kind of main things to understand when you're looking at conversions. So Roth, if you look up Investopedia on Google, you're going to find a simple definition of the Roth. It is an individual retirement account allowing a person to set aside after-tax income up to a specified amount each year. Both earnings on the account and withdrawals after age 59.5 are tax-free. Now, you can see the little caveat I put in there, the star, C, the 5-year rule. This is a basic definition, but it really misses a lot of the nuances inside of a conversion and how people get money into Roth. So if you read this definition, you may think, well, that's easy. I understand how that works, but that's not a complete definition of what a Roth is. It doesn't show all the details of it. So that's what we want to talk about today. First thing, contributions versus conversions. So when most people think about how do I get money into a Roth account, they think about contributions. Contributions come from earned income. So to do a contribution, and remember, there's 2 ways to get money into your Roth account. One is through a contribution. That's what most people think about. The other is through a conversion. We use conversions most, probably 99% of the time when we're doing tax planning. But a contribution is typically what people do while they're working. So we're working, we have earned income, which you must have earned income to contribute to a Roth account. And most people, when you think about a Roth, they're thinking about Roth IRAs, where you can contribute the $6,000 annually, or an extra $1,000 or $7,000 if you're age 50 plus. If your earnings are too high, then you cannot contribute to Roth IRAs at all. Now, the caveat in there is if you have a retirement plan, a 401k type plan that has a Roth component to it, then these limits would be different. Okay, you could put a lot more into those plans as you could, and then you also don't have the income limits that you do on the Roth IRAs. But the main thing I want you to understand about contributions is you have to have earned income. So you can't, and there is a limit as to what you can put in, depending on kind of how you're doing that, whether it's through your employer plan or on your own in your individual retirement Roth account. You have those limits. We use conversions. So let's talk about conversions. Number 1, you do not have to have income to convert. Okay. You can convert as much as you would like. So we do not have the limit as to how much we can convert into a Roth. We as long as, well, there is a limit. I guess I should say this. The limit is the amount of money you have in your qualified accounts, your IRAs, your 401ks, because that's where the money must come from. Okay. So we're basically, that's why they call it a conversion. You are converting an IRA account, or that's some money from that account. You are converting it into a Roth. Okay. So when you do that conversion, you are, say you had a $100,000 IRA and you wanted to take 10,000 out and move it over to your Roth. You can do that. That event is a taxable event. So you must pay taxes on that $10,000, or it must show up on your tax return as taxable income. Once it goes into the Roth account, it's never taxed again. Okay. As long as you meet the rules. Then we're going to talk about the 5-year rules next. So conversions are very, very helpful because they allow us to move a lot more money. And for our retired clients, when we're doing tax planning, if we had to rely on the contribution method, they don't have earned income, most of them, so it would not work. So we use conversions. Okay, conversions are a great tool to getting money from accounts that we still owe tax on, pay the tax, and get it into an account that will never be taxed again. And there's many reasons as to why we would want to do that. We're going to leave that for another day, but these are the two ways of getting money into a Roth, and we're typically going to use the conversion method because of the limit availability and also the income, that we don't have to have income to do it. All right, let's talk about the 5-year rule because this is really important. All right. If you open a Roth account, if you are older than 59 and a half and you have owned the account more than 5 years, then earnings and principal you can take out tax-free and penalty-free. Okay. So that's where we're trying to get to. We're trying to get to you being 59 and a half and you've had the Roth account open for at least 5 years. Okay. If you're older than 59, but your Roth account has not been opened for 5 years, then you have to pay income tax on the earnings if you take them out. Okay. So the main thing, what we're trying to do a lot of times when we open Roths early is we'll open a Roth and put $1,000 in it just to get this 5-year behind us. Because even if you are age 59 and a half, if your account that you have your Roth account in is not 5 years old, then you have to pay income tax on the earnings if you take them out. Okay. Now, most of the time, this is not a big deal because we're trying to get money from other accounts anyway and putting it into a Roth for long-term. That's kind of your last money you would use, but it is a rule that we need to be aware of. And then another reason, why we would, just get an account opened so we can get the 5-year clock ticking. Now, when you put new money in, so let's say you have a Roth account that is 5 years old today, and you added another 10,000. That 10,000 does not have a new 5-year clock. It does not matter. So it doesn't matter when the money went into the Roth. It is just the fact that you've had the account open for 5 years. Okay. So that's why putting $1,000 in a Roth account, whatever it takes to get your Roth funded and have that clock ticking sometimes is important. Not always, because if it's money that you don't need for 10 plus years or whatever the case, then it's not really needed to get it started. But a lot of times we'll do that anyway. The other thing, Dan, if you are younger than 59 and a half and own the account more than 5 years, you typically, owe income tax and a 10% penalty on the earnings you withdraw. But you can take out the principal amount. So even though you're under 59 and a half, you can take out the principal on that account without paying the 59 and without paying the 10% penalty. So there's some positives there that that people can use. But once again, these accounts are typically used for long-term growth. It's the last money you want to touch, but knowing the rules are important. And then the last one down there, if you're younger than 59 and a half and own the account less than 5 years, then once again, you owe the income tax and the 10% penalty on earnings you withdraw. You can avert the penalty for exceptions like first-time home purchases, qualified education, but you still owe the taxes. Okay. So there's kind of the 5-year rule. I hope that's, helping you kind of understand the conversions. I think the couple of simple things to know there. Number one, get an account open, get the 5-year clock ticking. Conversions do not require, you to stay within inside of an income limit or a conversion limit. So we can convert as much as we want, and then as long as we meet the 5-year rule, then we're good to go. I hope that helped. Y'all have a great week, and don't forget, the end of the week, hopefully I'll get a video out discussing what the Fed has done and how that's affecting the markets moving forward. Y'all have a great week. God bless. Talk to you soon.